ADMA Biologics, a biopharmaceutical company, engages in developing, manufacturing, marketing specialty plasma-derived biologics for the treatment of immune deficiencies and infectious diseases in the United States and internationally. Okay. They've been around since 2004, 623 employees. So, Scott, where are these guys headquartered?
I think they're headquartered in the Northeast somewhere. Or they might be actually. Hang on.
Like Boston?
I thought so.
New Jersey. Anyway, so yeah. New Jersey has a lot of pharmaceutical companies. It has a very big network of life sciences, pharmaceutical, biotech businesses. Okay, so they're playing in an area where there's a lot of talent available to them. Wow. 305% rate of return. Beautiful.
Yes. That's actually a couple YouTubers that I watch mentioned them, and one of them was Scott. I think Scott was looking into them before the rise, when they were just starting to recover a couple years ago. But yeah, as you can see, it's really taken off.
Yeah, yeah. What the heck happened? Did they cure cancer? So let's take a look. So the 4P looks
it would still be going up if that was the case, but
so their 4P looks rational, 27. They're strong buy 15. Okay, so beautiful growth. Now they are a little bit on the smaller side, right? $382 million. It's growing at 63%. That's very good growth. They're just little. So it's kind of like, okay. $119 million for that quarter, 78% growth rate. Growth looks great. So that looks good. Free cash flow, they are producing free cash flow. And that's why they probably just exploded. Once they became profitable, free cash flow, high growth, and then gross margins of 49.48%. Gross margins are expanding probably because their scale. As they get bigger, the per unit cost is going down because of efficiencies, economies of scale. Okay, so that looks good. Now, if they're growing at 63, what's going to be kind of a little bit of a guessing game is, all right, can we do a accurate forecast of those free cash flows? Well, it's going to be hard because, see, here's an example. In the second quarter, they're at 43.5 million, and then they dropped to 23.9 million. So it's kind of a little bit of up and down. So it's hard to predict that. The good news is it's positive. Totally good news. And the stock is really priced. It's really gone up in value, and it was kind of bouncing around at like $5 a share, and boom, it's at $18 a share. Are there best days behind us or ahead of us for this stock? Well, it's not obviously a incredibly discounted stock, right? We're at 79 million. Let's put that into a valuation and see where we get. Okay, so this one here is ADMA. So this is a smaller business, so the discount rates are a little higher, 8.5. For now, I'm going to leave that alone. And we said 79 billion was the run rate, and it's growing very quickly. So I'm going to say it's going to grow at 25%. Let's be a little more aggressive at 30%. The revenue growth is at like 70%, so I'm going to go 35%. Okay, first 4 years, just really see that free cash flow take off. All right, let's take a look at their balance sheet, see kind of the amount of cash and debt they have. See what we're doing. Okay, so
yeah, I just looked at their cash and debt. So it looks like they almost have enough cash to pay off the debt. Not quite.
EBITDA is good. So yeah, good balance sheet. So they have 86.7 of cash, 111.3 of debt. Go for it, Kiter.
I took a look. They have cash because they are diluting their shareholders. They are issuing stocks like crazy. Take a look at the number of stocks are outstanding. This is probably the way to raise cash. In my opinion, maybe I'm wrong, but that's what I just quickly looked at.
Oh yeah, the total common shares is going up.
Yeah, very good point. look, see how we've seen the share count really go up. It's been going up every quarter. Very good point. So you have a stock price that's expanding, and you have share count that's going up. So this is a negative, that share count keeps going up because you're diluting the company across more shares. But it's not crazy. I mean, it's going up. It went up a lot in previous years. Like in 2021 to 2022, not it did go up though. It's like 10% more shares. And then from here to here, not too bad. More like 8% of shares. But from 2020 to 2021, holy smokes, you had a big jump up. Okay, so shares outstanding 236.39. So net market cap 4.36 billion. So 5% discounted, and that's a pretty aggressive free cash flow growth. So they're fairly priced. Now let's look at earnings per, and this is really the principal valuation, right? So they're fairly priced, and that stock price has really run up. So could I see the stock price doubling in the next couple years? If the momentum continues, absolutely, right? Because this thing could just be a momentum stock and take off. But the fundamentals are telling me that, hey, it's fairly priced. It's not like a really great opportunity. Four analysts cover it. And one of them is a little bearish, 14. That's not too bad. And then one of them is optimistic at 26. So we have 7 analysts that are predicting the 2025 figures, and it's at 74 cents a share. And it's going to grow nicely. Okay. Now, revenue growth, you see how the revenue growth is expected to really slow down. You see those numbers, Scott? So are they really going to go from growing at 66% down to 14? I mean, that's like slamming on the brakes. And it doesn't look all that interesting to me. If it's growing at 14%, I have to scale back my free cash flow forecast because I'm not expecting that they're going to grow that fast. So that would be a red flag if their revenue kind of slows down that fast. It slows down to that level. So this was 71 cents. And I'm going to give them a 36, growth rate of 15. So you can see that the stock price based on earnings per share would be exciting. And maybe this was a little too high. Okay. But still, I think earnings per share could keep this stock price really moving because it is a high grower. It has momentum. Let me look at it over here. I mean, it hasn't moved a whole lot in the last 4 months, 5 months. It's up 5%, which is good. It just, I think the market really ran up and then it's kind of taking a breather. It went from $5 a share up to $16 a share. And it's like, okay, 370% rate of appreciation. And from there, the market's kind of like, okay, let's not go up anymore. So it's kind of paused for the last 2-3 months. This was a tricky one. If they can keep growing at 60%, this thing's going to keep flying up. If they start growing at 14%, I wouldn't be touching this stock because I think it's going to come back down. The stock price is going to come back down. So that's your decision, is how fast do you think they're going to grow? I would study what forecast. I'm sure that the company's communicating like their guidance, like, hey, this is where we think we're going to grow. I would encourage you to read the earnings announcements and see how they're guiding and see if they're guiding that, hey, we're going to grow at 20% or 15%. Where are those analysts getting those projections?
Yeah, I would agree with that assessment. And I would also want to know if they're going to continue issuing shares and how much, right? Because I'm glad that slowed down, but that is a concern.
Mm-hmm.
But I will say on the positive side, despite the dilution that's happened, it's still gone up, 300%. So
Yeah.
So imagine how much it would have gone up if they if they hadn't been issuing all these shares.
Yeah. Incredible.
So in that case, Scott, why did they issue that many shares? I mean, they could be doing lovely without issuing. So why?
Well, that's a good question, but like you said, the companies need capital to expand their operations, right? And it could be that they were saying, all right, we've now crossed these hurdles, we've gotten this approved, and I mean, I don't know, I'm just speculating, right? But I know that I do know that so they're not a pharmaceutical company like Pfizer or something or Novartis that make generic drugs or drugs that go on the shelf. I think they're more specialized, and they're targeting things against diabetes, I believe. And they're almost like a business to business company rather than to consumer, I believe. So, but they have a specialized manufacturing process that they do themselves that I know. Look at that. So contract manufacturing.
Look, Scott, I'm in that case. I second to Victor that this needs to, listen to maybe to read the 10K, 10Qs, to listen to the conference call. Because I'm raising the point of the dilution, but it's not necessarily be negative at this where they are in the cycle. Like for example, maybe Merck or Johnson & Johnson wants to partner with them, so they are telling them, yeah, we will buy 30% of the company. So how do they do it? They are issuing shares, and the other big company is buying them. So it can be viewed as positive, not necessarily negative, but needs to be studied.
Yeah, that could be too. Pharmaceutical companies and biotech in general can take a lot of research to if you really want to understand, because there's so many companies, and especially small companies in the space, right? And before things are approved, like if you really want to know which companies are going to do well, I mean, that's a career in itself, trying to understand like which companies in the biotech space are going to succeed.
Yep.
Yeah, that's what Charlie Munger used to say. He's investing in his circle of competence, you said, right, Victor? And this is not mine, at least.
Yeah, I mean, I'm in Catalyst, United Therapeutics, and now Lanthium. They have really good fundamentals. It kind of makes logical sense that they're going to keep growing. This one, the run up is like really interesting, but also in the same spot is risky. Did it run up and is it going to come back down? The risk being, if it comes back down, you're sitting on a 20, 30, 40% loss. So that's what you got to analyze enough to be comfortable that, no, it's going to keep going up. Actually, they had a breakthrough and their drug, like you were saying, maybe Eli Lilly's super interested, and they actually are now beginning to sell a bunch of it. That's going to accelerate their growth. So if that's the case, hey, these guys are going to keep going. It's not going to stop there. But that's what has to be analyzed. And I'm trying to see if we can quickly look at. So here's their growth. Here's their announcement, right? November 7th. So this is 2 months ago. And so third quarter, compounding growth, total revenue grew 119%.
Oh, that's interesting. I didn't know S&P has a small cap index, but that makes sense.
Yeah. So here's guidance.
Let me add something actually. So this reminds me of something I heard about Palantir recently, and not to make the comparison, because I certainly don't expect this company to be another Palantir, but I believe that part of the growth in the Palantir stock price was a little bit artificial, because so that they were, I think they switched over to NASDAQ in the market, right? I'm talking about Palantir. And I think when that happened, index funds and had to buy Palantir to add it, right, to the NASDAQ, to their NASDAQ index. And that was kind of an artificial inflation of the price. So it could be that part of the price inflation here was when it was added to this S&P index. I don't know.
Could be. So coming back to ADMA, right? So their revenue for fiscal year 2024 and 2025. Okay. So fiscal year. Okay. So in 2025, they're going to be a $445 million company just in this statement alone, right? They're guiding that 400 is 2024, 445 is 2025. This is about 10% growth. You with me, Scott? So if you compare this to that, it's $45 million difference. Divide 45 by 400, you're at 11% growth. So the growth, if we believe this number,
Uh-oh,
is,
Victor?
uh-huh.
Oh yeah, I just lost it for a second.
So if we believe these numbers are guiding, they're saying, hey, we have seen this explosive growth, but we may be slowing down to 11% growth is what they're saying here. Okay. So we got to, analyze the latest announcement and then put that into your process, which is, okay, they're not growing at 60% plus. They're going to grow in 2025 at 11%. Maybe they're getting low. So maybe it's 15, but still it's far lower than 63%, which is what they've done in the trailing 12 months. So there's some evidence there.
This is a company that I would DCA into because of that, because of the uncertainty, for sure.
Yeah. And I like the fact that you're looking in healthcare. I think healthcare has a lot of good opportunity because it hasn't been this crazy technology space where everything's going up, it seems, except for Adobe. And it's like, geez, man, it's kind of hard to find, discounted stocks when everything's gone up so much. But in healthcare, it's like it's been kind of in a winter, so to speak. It's like there's probably some overpriced stocks, but there's probably more unappreciated discounted stocks or stocks that are really. Remember how I made that statement that biotech is in a way a lot like technology. The reason I say that is these growth rates. This is like technology-like growth, and that's what I meant. Is that's where biotech becomes super valuable, super fast. It's these growth rates. That's what the market gets excited about. So I love that you're looking in a space where I think you can probably find a couple winners for 2025, whether it be ADMA or something else. Keep looking in healthcare, keep looking in biotech, keep looking in pharma. These are not overly complicated businesses. I don't have to be a chemist or have a PhD in biology to know that Eli Lilly is really profitable. No. And that their drugs are really working. Those are all rational kind of understandings. And so that's what I would say is a kind of a departing thought is on ADMA. More homework needs to be done here, but keep looking in this space. Keep looking in this industry because I think you're going to find good buys for 2025 in biotech.